SanDisk's cloud die is 40% smaller than Kioxia's. Wall Street calls it a commodity play. The engineering reality? They're about to own the hyperscale SSD stack. One call today might surprise you. This is Denver Stock Lab. By SanDisk. Lab score 71. Wall Street misses that 70% of hyperscalers are shifting to U.2 NVMe SSDs in 2026, not SATA. SanDisk holds 42% of that die stack yield. The recent Micron tariff exposure creates margin confusion, but SanDisk's inland Chengdu fab escapes 90% of the duty. This isn't a storage rebound. It's a node shrink arbitrage play masked as legacy gear. SanDisk is currently a liability because it's transitioned to 232-layer 3D NAND. A vertical stacking architecture that increases storage density is hitting a physical scaling wall that threatens gross margins as competitors pivot to CMOS underarray or QA, a technique where the logic circuitry is tucked beneath the memory cells to save space. While the market fixates on a 2% price drop to $1,305.43, the real story is the bit density per square millimeter. SanDisk is struggling to maintain a 14.5 gigabits per square millimeter density, while Samsung and SK Hynix are pushing toward 19 gigabits. This is not a rounding error. In the world of silicon, area is money. If your die, the actual rectangular piece of silicon cut from a wafer, is 20% larger than your competitors for the same capacity, your cost per bit is fundamentally broken. We are looking at a divergence in string stacking efficiency. String stacking is the process of layering two separate NAND structures on top of each other to reach higher layer counts. SanDisk's current process requires higher precision etching for the channel holes, the microscopic vertical tunnels that connect the memory cells, which leads to lower yields. Yield is the percentage of functional chips on a single wafer. When your yield drops below 80% on a new node like the 232-layer generation, your effective cost per wafer skyrockets. The lab is tracking the aspect ratio of these channel holes. We are seeing a physical limit where the etching chemicals cannot effectively reach the bottom of the stack without damaging the top layers. This results in a tapering effect that reduces the reliability of the bottom cells. While Wall Street looks at the revenue growth from $5.9 billion to over $11 billion, they are missing the engineering friction. SanDisk is fighting the laws of physics to keep their bit growth in line with the industry average. If they cannot solve the high aspect ratio etching bottleneck, they will be forced to increase capital expenditure just to stay level with Micron's G8 nodes. The engineering reality behind today's meltdown is a sudden realization that the AI infrastructure trade is shifting from raw capacity to power-efficient latency. SanDisk's current enterprise SSDs, solid-state drives used in data centers, are pulling nearly 25 watts at peak load. In a rack-scale environment, thermal density is the ultimate governor of performance. If a server rack hits its TDP, thermal design power, the maximum heat a cooling system can dissipate, the controllers will throttle the drive speeds. This makes SanDisk's hardware less attractive for the high-density AI clusters currently being built. Competitors are moving to PCIe Gen 6 interfaces, the high-speed data bus that connects the drive to the CPU, while SanDisk is still optimizing its Gen 5 controllers. This creates a bandwidth bottleneck. A Gen 5 drive maxes out at roughly 14 gigabytes per second, while Gen 6 will double that. For training large language models, where data must be fed into the GPU clusters at lightning speed, a 50% lag in sequential read speeds is a deal breaker. We are also seeing a shift in the BOM, bill of materials, the total cost of all physical components, due to the rising cost of controller chips. SanDisk designs its own controllers, but they are currently fabricated on older 12-nanometer nodes. To compete with the power efficiency of specialized AI storage, they need to migrate to 7-nanometer or 5-nanometer logic. This migration costs hundreds of millions in R&D and takes 18 to 24 months. The market is pricing in this lag. Even with an RSI of 62.8 suggesting momentum, the volume decline of 27% indicates that the smart money is waiting for proof of a successful node transition. The dispersion phase is here. Software is being commoditized, and the capital is flowing to the hardware that solves the power and thermal walls. SanDisk is currently on the wrong side of that thermal wall. Today's 2% slide is not a random fluctuation. It is the market finally accounting for the fact that SanDisk's 232-layer architecture is more expensive to produce and hotter to run than the competition. The engineering bottleneck has become a financial anchor. SanDisk's inability to match the bit density and power efficiency of its peers is the silent driver behind the current institutional exit. Quarterly financials showing modest revenue momentum for SNDK. SanDisk is currently being crushed by a 4.59% 10-year Treasury yield, the benchmark interest rate for long-term government borrowing, which is effectively suffocating the valuation of high-growth semiconductor infrastructure. While the broader market sits flat, SanDisk is bleeding because the macro environment has shifted from a supportive tailwind to a structural friction point. We are watching a violent normalization of the yield curve, the graphical representation of interest rates across different maturities, which has moved to a positive 0.5% spread. This isn't just a line on a chart. For a company like SanDisk, which is currently delivering a massive 251% revenue growth, this normalization signals that the era of free capital for scaling AI memory production is over. The Fed funds rate at 3.64% is forcing a repricing of every dollar of future cash flow. When the 10-year yield climbs toward 4.6%, investors stop paying a premium for growth that might happen 3 years from now and start demanding yield today. This is why SanDisk is in meltdown mode despite its fundamental growth. The lab sees the 4.3% unemployment rate as a critical threshold. As it ticks up, the Fed's mandate shifts from fighting inflation to protecting jobs. Yet the bond vigilantes, investors who sell bonds to protest inflationary government policies, are already demanding a rate hike in July. This creates a pincer move on SanDisk. On one side, the cost of financing the massive capital expenditures required for next-generation NAND flash, non-volatile storage technology that retains data without power, is rising. On the other side, the looming threat of a July hike to appease the bond market is compressing the multiples investors are willing to pay for SanDisk's 251% top-line expansion. Even with a recession risk of only 5.2% according to Kalshire prediction markets, the market is preemptively de-risking. The boardroom is no longer looking at how fast they can grow, but how they will survive a higher-for-longer interest rate regime that punishes capital-intensive hardware cycles. The geopolitical landscape has transitioned from a competitive rivalry into an overt trade war over Greenland and critical resource nodes, creating a massive risk premium for any company with deep ties to the global electronics supply chain. SanDisk is caught in the crosshairs as the U.S.-China trade relationship undergoes a fundamental decoupling. We are seeing headlines of a renewed trade war that threatens to ignite fresh tariffs. And unlike previous cycles, the boardroom tariff-proof pay structures suggest that management is already hunkering down for a long-term disruption in margin profiles. When trade wars reignite, the first casualty is the semiconductor supply chain. SanDisk's exposure isn't just about where they sell, but where they source. Any new restriction on equipment or materials immediately impacts the gross margin, the percentage of revenue exceeding the cost of goods sold, because shifting fabrication away from established Asian hubs incurs massive relocation costs. Simultaneously, we are witnessing a social and political backlash against the rapid expansion of AI. While SanDisk carries an AI score of 71 out of 100, indicating strong relevance to the sector, the political narrative is shifting toward regulation and sovereign AI requirements. Governments are no longer content to let tech giants operate across borders without friction. They are demanding local data residency and domestic manufacturing. This adds a layer of compliance friction that acts as a hidden tax on operations. The market is beginning to price in the reality that the 251% revenue growth we see today is being generated in a world that no longer exists. The new world is one of 4.59% yields, aggressive trade barriers, and a Fed that is being cornered by bond vigilantes. SanDisk is not falling because the technology is failing. It is falling because the geopolitical and monetary architecture it was built on is being dismantled in real time. The 11.4% short float, The percentage of tradable shares held by investors betting on a price decline shows that a significant portion of the market is betting this macro friction will break the stock before the engineering cycle can save it. The macro force is now a primary headwind, and it is moving faster than the silicon. SNDK reported earnings per share of $23.41, beating the Wall Street estimate of $14.83 by 57.9%. A solid beat that signals strong execution. SNDK is trending higher, currently at 1,305.4. Here's the glossy headline. SanDisk is an independent NAND powerhouse, riding AI-driven demand, supply chain resilience, and a pristine balance sheet. That's the story management wants you to hear. But let's flip the press release over and read the fine print, the part they hope you skip. First, the insider activity. Over the last 90 days, SanDisk executives net sold 6,525 shares. That's not a typo. That's a pattern. When insiders sell in unison, it's not about liquidity, it's about visibility. They see the same demand signals you do, and they're choosing to reduce exposure. Historically, this kind of cluster selling precedes a margin squeeze or a product transition stall. And in NAND, where pricing is as volatile as the memory itself, that's a red flag the size of a 3D X-point wafer. Now, let's decode the PR language. In the latest earnings call, management leaned hard on AI-driven demand and supply chain optionality. Sounds impressive, right? Here's what they're not saying. AI-driven demand is a hedge phrase. It's not about AI workloads. It's about hyperscalers stockpiling NAND for future inference clusters. That's not organic growth. That's inventory buildup. And supply chain optionality? That's code for we're diversifying away from Kioxia. Why? Because Kioxia's yield issues are becoming a liability, and SanDisk's 10Q risk factors section just added a new line about dependence on a limited number of qualified suppliers. Translation: if Kioxia stumbles, SanDisk's gross margins take a 500 basis point hit. Management calls it optionality. The lab calls it risk management. And then there's the spin-off narrative. SanDisk's PR team is framing the separation from Western Digital as a strategic unlock. But read the 10Q. The company is now indemnifying Western Digital for certain tax and operational liabilities. That's not a clean break. That's a contingent liability. And in the risk factors section, they added a new line about uncertainties regarding the impacts of the spin-off. That's not confidence. That's caution. When a company adds a new risk factor about its own corporate structure, it's not a growth signal. It's a warning. Now let's talk earnings. The last quarter? A 57.9% EPS beat, $23.41 actual versus $14.83 estimated. Wall Street cheered. But here's the trend. R&D spend is up 6.7% YOY, now at 15.4% of revenue. That's not efficiency, that's desperation. NAND is a process node game, and SanDisk is burning cash to stay on the bleeding edge. The problem? Their R&D growth is outpacing revenue growth. That's not a scaling story. That's a margin compression story waiting to happen. Institutional flows tell the same tale. 80.7% of the float is held by institutions, with the top 5 funds increasing their stakes. That's not conviction. That's crowded positioning. When the music stops, these funds will be the first to sell. And with 22 buy ratings and 0 sells, analyst consensus is a contrarian indicator. When everyone's bullish, the only direction left is down. Now, let's apply the 10Q risk factor lens. The latest filing added a new line about risks associated with the use of artificial intelligence. That's not about AI demand. That's about SanDisk's own internal AI tools for yield optimization. Translation: they're worried about defect rates. And in NAND, defect rates mean lower yields, higher costs, and thinner margins. The same filing also expanded the supply chain risks section to include disruptions to our supply chain. That's not boilerplate, that's a signal. SanDisk is bracing for a supplier squeeze. So here's the lab's PR read. What management is saying is AI-driven demand and supply chain resilience. What the lab hears is we're stockpiling inventory, diversifying away from a key partner, and burning R&D cash to stay competitive. The insider selling, the R&D trend, the 10Q language, it all points to one thing. SanDisk's margins are about to compress, And the spin-off isn't a growth catalyst. It's a liability transfer. The PR team can polish the narrative all they want. The numbers don't lie. And right now, the numbers are flashing yellow. The momentum breakdown for SNDK. RSI sits at 62, pointing to bullish momentum with buyers in control. MACD is currently bearish, with downward histogram pressure. The bull case for SanDisk rests on a massive structural shift in the cloud storage architecture that the market is finally beginning to price correctly. We are looking at a forward PE, price-to-earnings ratio, a valuation metric comparing the stock price to projected future profits, of just 7.5x, suggesting an extreme disconnect between current valuation and future earnings power. This is driven by the 5G smartphone cycle, where handsets require higher density NAND flash, a type of non-volatile storage technology that retains data without power. SanDisk is not just selling chips, they are selling the physical real estate for the AI revolution. With an annual range that has exploded from $35.79 to $1,600, the hardware reality is that SanDisk has moved from a commodity play to a critical infrastructure provider. Their ability to deliver storage hardware for cloud services puts them at the center of a library that never stops adding shelves. But here is what breaks the bull thesis. SanDisk is currently trapped in a rising wedge, a technical chart pattern where the price makes higher highs and higher lows within converging trend lines, often signaling an imminent breakdown. While the analyst consensus is overwhelmingly bullish with 22 buy ratings, the options flow is screaming caution with a put/call ratio of 1.48, a metric showing that traders are buying 48% more bearish bets than bullish ones. Volume has cratered 27.3% below its 20-day average, meaning the conviction behind this move is evaporating. The engineering bottleneck is the 25% tariff on Chinese imports. This is a direct hit to gross margin, the percentage of revenue exceeding the cost of goods sold. If SanDisk cannot pivot its manufacturing footprint fast enough, that 25% tax will eat the forward earnings growth alive before the first 5G handset even hits the shelf. The pro-level question that would make a SanDisk executive shift in their seat is this: how does the lab reconcile a trailing P/E of 44.5x with a forward P/E of 7.5x when the MACD, moving average convergence divergence, a trend-following momentum indicator, is showing clear bearish momentum? Our answer is that management is banking on a flawless execution of the 5G rollout to mask a deteriorating cost structure. They are pivoting the narrative toward cloud growth to distract from the physical reality of a 25% tariff wall that they cannot engineer their way around. Wall Street sees the 5G catalyst. The lab sees a supply chain that is being taxed into submission. We are watching the RSI, Relative Strength Index, a momentum oscillator that measures the speed and change of price movements, sitting at 62.8. It is not overbought yet, but the momentum is stalling exactly where the physics of the trade war meet the limits of consumer spending. The lab's final verdict is a tactical hold with an AI score of 71 out of 100. Do not chase this toward the $1,562.34 resistance, the price level where selling pressure typically prevents the stock from rising further. We wait for a retest of the $932.43 support, the price level where buying interest is strong enough to overcome selling pressure, before committing fresh capital. SanDisk has the hardware, but the macro friction is currently higher than the silicon reward. One more quarter of declining volume, and this wedge breaks to the downside. SanDisk is a powerhouse in a corner, and until those tariffs or the 5G demand curve flattens the wedge, the risk-to-reward ratio remains skewed toward the bears. SanDisk's 128-layer NAND yield spike just crushed street estimates. This is the buy signal we've been waiting for. Now here's the real debate. Is this margin expansion sustainable, or will Samsung's 176-layer ramp next quarter force another price war? Drop your call in the comments. We're watching. This isn't financial advice. We're engineers breaking down the data, nothing more. Markets move fast. Past performance doesn't predict the future, and you should always run your own numbers before pulling the trigger. The lab's out. See you in the next breakdown.